Welcome back to the Deep Dive. Today we are laying down the foundation for our analysis, wading into the bedrock of infrastructure and global finance.
We are.
We're focusing on one of Japan's most venerable construction and development groups, and we're analyzing the core factors driving its colossal performance.
And what really grabs your attention here, it isn't just the monumental scale of their projects.
No.
It's the almost counterintuitive financial resilience this firm showed, especially while the rest of the industry was really struggling with massive cost inflation and, severe labor challenges.
That financial resilience is precisely why this deep dive is so necessary.
It is. Our mission here is to move beyond the usual surface-level talk about construction cycles and global real estate.
Right.
We're going to dissect the integrated strategy, the consolidated financials of this long-established group to really identify the precise strategic variables that determine both future growth and, of course, the inherent risk.
The specific leverage points that really matter to anyone tracking large-scale engineering and infrastructure. So to understand the pressures they face today, I think we have to appreciate the sheer depth of their history. This is a business with a legacy stretching all the way back to 1840.
It's incredible. You can essentially track the arc of modern Japanese development right through their project portfolio.
From pioneering the massive public works era, the railways and dams in the 1960s.
Right, all the way to constructing the very first super high-rise buildings during that period of rapid economic growth.
So they weren't just participating in history, they were literally shaping the physical reality of the nation.
And that continuity, coupled with the modern scale, is what's so fascinating. The structure today is a sprawling global group.
A huge group.
It's the parent company, sure, but it's operating alongside this vast network of domestic and international subsidiaries. I mean, to give you an idea of the reach, that was over 178 subsidiaries and 82 affiliated companies as of 2020.
And they organize all that output across 3 core segments.
3 main ones, yes. Civil engineering, building construction, and then the increasingly important development and other segment, which is where they house their design and specialized engineering services.
And their whole identity seems defined by this kind of dichotomy. On one hand, they champion the technical. Their fundamental strategy is Jujutsu Risha.
Technology first.
Technology first. But that is supposedly underpinned by a foundational culture they call Yindu Shugi, or humanitarianism, describing a family-like corporate culture as the source of their value. Sounds good on paper.
Well, exactly. That family dynamic hasn't completely insulated them from some pretty major legal headaches. We have to address the elephant in the room.
The ongoing, highly material legal risk.
Yes, they are still operating under the shadow of the antitrust violation case, the one related to the Chuo Shinkansen terminal stations.
And this isn't just some minor fine. This is about the integrity of competitive bidding on a nationally critical project. They were found guilty by the lower courts.
They were, but they continue to fight the conviction, appealing to the Supreme Court as of 2023.
And their defense isn't just a flat denial, right? They're arguing something more nuanced.
They are. They're arguing that given the unique high-security nature and just the sheer complexity of that specific project, a true competitive environment, as defined by antitrust law, it simply wasn't present among the very select few players capable of doing the work.
That's the core of their argument.
It is. But regardless of the legal nuances, the financial reality is that the outcome remains a tangible risk. A negative Supreme Court ruling could lead to significant financial penalties, reputation damage.
And that could potentially affect their ability to secure future public works.
It's a major stress test on their long-term credibility and financial stability.
Okay, now let's talk about the numbers. Shifting to the recent past, say fiscal 22 through 24. If you had listened to any general construction forecast during this period, logic dictates that with global inflation soaring.
Hitting commodities, materials, labor.
Exactly. Margins should have been absolutely hammered. And yet this group achieved 4 consecutive periods of increased revenue and net income, leading right up to the end of fiscal 24.
It runs entirely counter to the expected industry narrative. The growth trajectory itself is certainly bullish. We saw revenue jump from, $2.39 trillion in fiscal 23?
Right.
Increasing robustly to a forecast of $2.66 trillion in 24. And they're setting their sights high, aiming for over $2.9 trillion by 2026. But you're right to focus on the profitability.
Because here's where the numbers tell the really surprising story. The consolidated gross margin ratio, it actually managed to improve significantly in this supposed inflationary squeeze.
It did. It rose from 8.5% in fiscal 23 to 9.2% in 24.
That is an almost unheard of margin expansion for a traditional builder in this kind of environment.
It is genuinely surprising, and it requires a deeper explanation than just saying they managed costs well.
So what's the reason?
Well, the company documents, they attribute this margin expansion primarily to successful project execution and, crucially, favorable gains recognition on large projects completed during that period. They state, now,
The improvement in profit and loss progressed successfully.
exactly.
But wait, if we step back, doesn't that statement, favorable gains recognition, suggest this might be more of an accounting timing triumph than a true strategic cost management moat?
That's a great question.
I mean, did they genuinely execute better than everyone else, or did they just bank the profits from projects finalized just as inflation spiked?
It was a bit of both, but timing played the dominant role. Think of it this way. For a company of this scale, many complex projects have cost lock-ins or material hedge contracts established years ago.
Okay.
When those projects completed flawlessly in fiscal 24, they realized gains based on older, lower-cost bases. Meanwhile, competitors who delayed execution or suffered unexpected overruns, they absorbed the current inflation.
So yes, it was timing, but it was timing that required near-flawless contract management. Fiscal 24 was an execution masterclass that let them realize gains just before the real squeeze hit.
Which leads directly to the question of sustainability.
It does.
And the management agrees. They themselves forecast a slight dip in the gross margin for the current year, fiscal 25, projecting it to fall back to 9.0%.
And that anticipation of margin compression is a crucial signal.
It tells you that the temporary tailwind from those perfect project completions is dissipating, and the persistent industry headwind of rising construction costs is finally catching up.
So maintaining that 9% margin floor moving forward is now the core challenge.
It is.
That challenge maintaining margins in a tightening domestic market, that has to explain why global scale is absolutely non-negotiable for their growth profile.
It's a massive and essential revenue generator. We see firm construction demand continuing globally, especially in high capex sectors.
Or specifically,
The U.S. and Europe are strong, particularly tied to massive investments in manufacturing, and Southeast Asia is showing a solid recovery. North America, primarily the U.S., is clearly the vast revenue market right now.
how much are we talking?
It contributed $413 billion in fiscal 23 alone.
That's a huge chunk of revenue. But as we know, operating in Western markets, especially the U.S., it carries its own set of risks.
Significant risks. You have to monitor geopolitical volatility, of course, but the immediate financial risks are inflation and the impact of rising interest rates on project financing.
Sure.
But what's strategic is how they are balancing that execution risk with forward-looking technology investment.
You're pointing to their big play in Asia, the gear facility they completed in Singapore. What makes this so strategic?
It's the direct link between their overseas presence and their core Jujutsu Risha strategy. The gear is explicitly designated as a global R&D and open innovation hub.
So what are they working on there?
They're focusing heavily on digital transformation, robotics, and sustainability technologies. It's not just a regional office to win more contracts, it's an engine designed to develop the technology that they will then export globally.
Reinforcing their technological moat. So they're using their international footprint not just for sales, but as a testbed and innovation center.
Precisely. And to provide financial insurance against all that volatility, we see them using standard financial guardrails, things like FX forward contracts and currency swaps to mitigate the foreign exchange risks.
They're managing currency risk aggressively to protect those profits.
They have to.
Okay, we've established that margin stability is the core short-term challenge. Let's zoom out. What are the 2 or 3 massive structural strategic levers this company is pulling that truly determine whether they hit their ambitious $1.5 trillion net income target by 2030? What's the hidden logic?
The single most critical factor, the one that underpins everything else, is technological decoupling from labor limits. So driver A is the success and scalability of A4CSL.
A4CSL, the Automated, Autonomous, Advanced, and Accelerated Construction System. This isn't just a buzzword. This is their core moat against the demographic reality of Japan.
a severe labor shortage, and is also their primary defense against the 2024 problem, which introduced those extremely strict caps on construction worker overtime.
Right. If they can't find workers, they must replace them, or maybe more accurately, multiply their efficiency.
Exactly. The A4CSL system uses integrated automation, IoT sensors, machine autonomy, all to execute tasks that were previously reliant on massive human input. And we have specific, dramatic proof of its effectiveness.
Tell us about the Naruz Dam. That achievement is genuinely startling.
So in October 2022 at the Naruz Dam project, they used the A4CSL system to achieve a staggering monthly concrete pouring record of 271,000 cubic meters.
271,000.
And why is that so remarkable? It absolutely shattered the previous 62-year-old Japanese record, which was set during the construction of the Kurobi Dam back in 1960. That record stood at only 147,300 cubic meters.
That is nearly a doubling of a 6-decade-old national record using technology. The implication is profound.
It is.
The success of their entire productivity future hinges not just on these massive high-profile dam projects, but on applying this same automation to high-volume standard tasks.
Like tunnels, using their A4CSL for tunnel system, and even general paving through their subsidiary Kajima Duro's focus on digital transformation.
So if that technology doesn't scale to every single job site, the moat shrinks significantly.
It's the difference between a demonstration and a commercially viable, scalable system. Now let's pivot to the second major driver, which is highly volatile.
The nature of their development assets.
Yes, the development segment, the 2-inch share, provides those juicy, non-construction margins.
But it seems to inject massive financial risk right onto the balance sheet.
It is the ultimate double-edged sword. The segment provides significant but inherently unpredictable profit swings through planned property sales. Think high-end office buildings, hotels, condominiums.
And these sales are critical for the next year.
Absolutely critical. They are expected to drive strong earnings in fiscal 25, compensating for any construction margin weakness. But this volatility can swing dramatically in the opposite direction.
We saw a major shock just a couple of years ago.
We did. We only have to look back to fiscal 22. They recorded a substantial non-recurring risk event, a massive $16.4 billion impairment loss on development assets.
And that wasn't just a minor write-down. That was a major shock.
It was a major shock that dramatically illustrated their exposure. The sheer scale of their retained assets is key here. Over $200 billion in property held for sale and over $300 billion in rental property as of fiscal 24.
That's $500 billion yen in exposure.
Which means that fluctuations in regional real estate markets, particularly if their core rental portfolio value declines, pose a constant material risk of an impairment loss that could instantly derail their annual profits.
So development is the high-octane fuel for their profits. But if the market turns, it's also the biggest potential break on earnings. Okay, what about the final piece of the productivity puzzle?
The human side of the labor crunch. Right, this is driver C, innovative labor management. This addresses the reality that even with A4CSL, traditional technical employees, the kujikanri, are severely overburdened by administrative and non-core site duties.
And the solution they came up with is genuinely inventive.
It is. They launched One Team Inc., a specialized construction site support firm. Its unique mandate is to hire and train non-technical staff.
People from outside construction.
Exactly. People coming from backgrounds like ex-shop clerks or general office workers, and they train them to handle site support tasks. So they are bringing in a whole new category of labor to take over the crucial but non-technical paperwork.
What kind of tasks are we talking about?
These site support specialists handle essential non-core duties like detailed photo documentation, managing digital blueprints, providing ICT tool support.
So the strategic genius is that this aims directly at relieving skilled technical staff.
Precisely. By outsourcing these essential yet non-technical site duties, they free up their highly skilled, high-value engineers to focus only on technical supervision and execution. It's a clever maneuver directly addressing the pressure points created by the 2024 labor regulation deadline.
Let's shift our focus to how they are managing their capital, which has been quite active recently. This is a crucial signal of management's confidence in cash generation.
The basic shareholder policy is built on stability. It's a stable dividend targeting a moderate 20-30% payout ratio. But the real headline-grabbing activity comes from their commitment to what they call
agile shareholder returns.
Agile shareholder returns, primarily achieved through aggressive share repurchases.
And We saw significant movement on that front this past spring.
Absolutely. The massive $30 billion buyback, resolved and completed in May and June of 2024, was a clear signal of confidence.
And it's not just buybacks. They're also cleaning up the balance sheet.
They are. They're reducing those old entrenched policy cross-shareholdings. For the listener, that's essentially the common practice in Japan, where companies hold shares in each other's businesses as a form of, well, friendly corporate stability.
And they are selling off these policy holdings, effectively unwinding old favors.
That's right. They sold 24.9 billion worth of these cross-holdings over 2 years, aiming for a 30 billion reduction goal. This directly frees up capital, enhances return on equity, or ROE, and signals a stronger focus on external shareholder interests.
So cash generation is strong enough to allow them to aggressively satisfy shareholders today while still funding the future.
Precisely. The capital allocation strategy outlined in the 2024-2026 midterm plan prioritizes a substantial $1.2 trillion. That is a massive figure dedicated to growth investment in R&D and strategic assets, alongside these increased shareholder returns.
They're not choosing between the two.
They're funding both simultaneously.
Okay, so let's tie this all together.
If we synthesize all these moving parts, the company's success over the next few years hinges on two critical variables. First, the immediate success of margin maintenance in their core construction segment will rely entirely on managing persistent cost inflation while simultaneously accelerating the successful widespread implementation of their A4CSCL productivity systems.
Across standard job sites, not just the flagship projects.
Exactly. And second, the overall consolidated profitability profile remains highly exposed to the successful timing and execution of those large, planned overseas development asset sales.
So if that technological scale-up lags, or if the global real estate market turns sour in the next 18 months, those ambitious 2030 targets become exponentially harder to reach.
They do.
The real question isn't whether the company can grow, it's whether their technological moat is deep enough and wide enough to truly overcome Japan's shrinking workforce, especially as they export that technology globally. Can robotics replace a century of construction tradition fast enough to truly decouple growth from demographics?
That is the structural dynamic you need to track.
And that's it for this week's Deep Dive. Thank you for supplying the material and joining us as we unpack this complex powerhouse of engineering and development. We'll see you next time.